My name is Erik Britton. I'm the Managing Director of Fathom Consulting. We're hosting a conference on the 7th of December at the Thomson Reuters building in Canary Wharf. I'm joined by my colleague Andrew Brigden, who's the Chief Economist here. The theme of the conference is the conduct of monetary policy over the last 10 years and even more than that, and that gives us a good opportunity to reminisce about our joint time at the Bank of England back in the late 1990s.
Yeah, I mean, I think I'd started at the bank before you as a placement student back in 1992, and that was a fairly momentous time for monetary policy because for a period we didn't have one after Black Wednesday, 16th September 92.
Golden Wednesday.
Golden Wednesdays, yeah, exactly. And but at the time it was chaos for a few days. Yeah, I mean, one of my earliest memories was being called into the Oak Room shortly after. The Oak Room is a oak-panelled room, as the name might suggest, but a very elaborate and elegant room that, you know, me as a 20-year-old had never been anywhere like that before. And Mervyn King had called in all the economists to announce that this was a great time for the bank. We were going to be inflation targeting within weeks, and that would lead to bank independence, and he was quite right.
One forecast that somebody got right a long way in advance. I was
Indeed.
outside the bank at the time of Black or Golden Wednesday, and looking on from afar as the bank jacked interest rates up to 12%, I think 15% was mooted for a while, and thinking that organisation needs some help, and that wasn't really the reason I joined. I just joined because what a prestigious place to be, and what a great time we had there. So even in 98, 99, there was a group of us in the Bank of England working there at the time, myself and you, and also Shamik Dar, Danny Gabay and Andrew Clare, who were all thinking the way the bank is set up with people thinking about the real economy on the one hand and people thinking about financial markets on the other, and the two sides of the bank never really meeting, not talking to each other, was a really stupid way to run a central bank, never mind an economy.
Yeah.
And wouldn't it be neat at some point to do something in the private sector that brought those two sorts of analysis together? And that was the germ of the idea that became Fathom down the line. Fathom was founded in 2003, not by myself, but by Danny Gabay, who sadly passed away a couple of years ago.
You know, Danny had great faith in me and I think taught me a huge amount. And in particular, he taught me not to believe everything that the Bank of England said. And that took a long time.
To believe anything the Bank of England said came later.
I can still remember the first note I wrote that kind of dared to take the position that something the Bank of England had said was not correct.
Right.
And he kept saying, you know, we'll beat this out of you, Andrew,
Absolutely.
we'll beat this out of you. And eventually did. I'm not you know, I don't take the opposite view that everything they say is wrong, of course, but you once you're outside the organisation, you can start to challenge and to think differently, I think.
And actually that was a problem in the organisation, not just that we all internalised that sort of hierarchical structure there, but if you did have any thoughts that were slightly different from that, from what was coming down from on high, it was difficult sometimes to express them and difficult to get those heard, because that hierarchy was so baked in to that organisation, and that was one of the things that I felt frustrating. So did Danny, so did Shamik, so did Andrew Clare, and yourself, I guess, too. And that was again one of the seeds, the germs of Fathom that came later.
Yes, yes.
And the concerns we had at Fathom about the vulnerabilities in the financial sector in the late 2000s, 2005, 6, 7, house prices being massively overvalued, all of those things that we were expressing to our clients at the time really came home to roost in 08, 09 with the financial crisis. And we were strongly critical, as you suggest, in the run-up and during that crisis of the conduct of monetary policy from the Bank of England and indeed globally. We were making very strong points about how the presumption that markets are efficient is not a sensible one to be going with. There's plenty of evidence that that's not the case. They don't operate like that. That the presumption that it's safe to ignore the build-up of debt in various markets, including the housing market, was not a safe assumption to make. You should really be thinking harder about that. The Bank of England's macro model that they were using at that time in the late 2000s, ahead of the financial crisis, had no measure of risk in it, which is an incredible thing to reflect on.
That's right. I think it had no measure of money either,
No,
which was
quite.
slightly puzzling.
Quite.
But yeah, it was very microfounded, I think, wasn't it?
Yeah.
I can't remember the name of it now, but I know they're not using it
Beckham.
anymore. Beckham.
Bend it like Beckham,
Yes.
and it bent it all right. And that was the sort of a picture of the mindset that informed the policymakers at the Bank of England, and not just at the bank, everywhere really around the world. And it was fundamentally flawed on many, many levels, a point that we repeatedly made ahead of the recession. And the recession occurred, and after that we thought, so this is now standing in the beginning of 2009, we're in the throes of the biggest global recession in 80 years, we're right in the middle of it. Central banks around the world had provided a massive slew of liquidity into financial markets under various names, and then also cut interest rates from where they previously had been, like 5, 6, 7, all the way down to 0, and simultaneously had implemented a massive stimulus through fiscal policy, huge loosening of fiscal policy, 5, 6, 7% of GDP, loosening of fiscal policy, really everywhere. And those things taken together, by far the biggest macroeconomic policy loosening of all time, certainly going back to the 1930s and probably further than that globally.
Yes.
And justified because of the severity of the recession. But we were very concerned, starting in the beginning of 2009, that just as the bank had mishandled, in our view, the run-up to the recession, that they were going to mishandle the aftermath too. And so we set up this conference, the Monetary Policy Forum we called it, that was aimed at thinking really carefully through the factors driving choices about monetary policy, not just in the UK but globally, and calling for ultra-loose money in this country, combined with unconventional measures of monetary policy such as quantitative easing and all the rest of it. We called for that at our conference in February 2009, and it was implemented shortly thereafter. I'm not saying because we called for it, many people were calling for it besides ourselves. And that's what transpired. Here we are, 10 years later. Can we just turn it off? It seems not, huh? It feels to me, and we can show evidence of this, that it's having, in the long run, a damaging effect on the UK economy. The big problem in the UK, and indeed globally, since the recession, is accounting for the shortfall in productivity growth right across the developed world.
Yes.
It's very difficult to attribute anything that can explain that shortfall adequately or satisfactorily. The only thing that changed at the same time as that changed was monetary policy.
Yeah.
So Fathom's proposed doing something about it is get off those monetary meds. We've been on them for 10 years and they're doing more harm than good now. So the theme of the conference on the 7th of December is calling strongly for a reversal of QE and a reversal of ultra-loose monetary policy. We're going to have to think carefully about how we do that, the timing of it, the sequencing of it, how we can do that. Can we do it and avoid a recession along the way? Are we going to get a recession anyway? All those sorts of questions we'll be discussing. But the time has come to accept, in our view, squarely and understand the implications of the fact that ultra-loose monetary policy held in place persistently undermines the supply side, the productivity growth rate of the economy in the long run. If that's true, and it is, then we've got to do something very different with monetary policy going forward, and that's exactly what we're going to be calling for at the conference.